The only thing we get out of it is the Japanese don't sell these bonds into the market. The Fed prevents that from happening. Why? Because the Fed is afraid, the U.S. government is afraid that if Japan is selling treasuries, treasury prices are going to fall. And so to prevent that, we create inflation. That is what the Fed did. They created more money, gave it to Japan to use to buy back yen to increase the supply of dollars in circulation. That is more inflation. And in fact, if you look at what happened to the Fed's balance sheet in the most recent week, it rose by over $10 billion. And that isn't even the $10 billion that came from the Bank of Japan. That is $10 billion in U.S. Treasuries that the Fed went into the market and purchased. So the Fed is not only doing quantitative easing without acknowledging it, but it's doing it even worse because it's doing it on the part of the Bank of Japan too. And if you think that's the end of the intervention, you're wrong. This is just the beginning.
A currency crisis thousands of miles away is suddenly becoming a problem Washington cannot easily ignore. Japan has been under pressure from a collapsing yen, rising government bond yields, and an enormous debt burden. And when Tokyo needs dollars to defend its currency, one obvious source of those dollars is the mountain of U.S. Treasury securities Japan owns. That creates a problem for America. If Japan sells treasuries aggressively, it could add pressure to an already sensitive U.S. bond market. But if Japan avoids selling them, how does it get the dollars it needs? That is where this interview takes a surprising turn. The guest argues that Washington has found a way to support Japan without forcing Tokyo to dump treasuries into the market, and that this could have consequences far beyond Japan. But what actually happened, what is confirmed, and where does the guest's interpretation begin? Let's break it down.
Okay, now I have been talking about the problem in Japan for many, many months now. In particular, how the problems in Japan potentially could cause a real crisis in the United States. Now, the problem they were having in Japan, the Japanese yen fell to a 40-year low against the dollar. You could buy over 163 yen for $1. The weakness in the yen was translating into rising Japanese government bond yields. The yield on the 30-year Japanese government bond hit an all-time record high, just under 4%. The Japanese didn't even start issuing that bond, I think, until earlier in the 2000s. But the 10-year JGB, which they had been issuing for a long time, the yield there rose to about a 30-year high. Inflation is a problem in Japan. Now, they were acting as if deflation was a problem, although they didn't really have deflation. They just had low inflation. But now they don't have low inflation anymore. Inflation is a big problem in Japan, yet the Japanese government is doing nothing about it because over the prior couple of decades, the Japanese government sold so many bonds in order to supposedly revive inflation, which was a huge goal. They said we don't have enough inflation, which was always BS, but they were really trying to keep the yen from rising. They were trying to prop up zombie companies from the bubble that burst decades ago. They were trying to help their exporters by weakening their currency. Well, they actually turned huge trade surpluses into deficits. They undermined their economy with their easy money policies. I was a critic of Abenomics the entire time that they were pursuing it and everything they've been doing in Japan since that huge bubble burst towards the end of the 1980s. But they accumulated so much debt, their debt to GDP is well over 200%. And I was talking about this spiral where Japan had to do something. Interest rates in Japan, their policy rate, which is the equivalent of our Fed funds rate, is 1%. How do you have a 1%, Fed funds rate when, your 30-year yields are 4%? You have a steep yield curve and you got inflation that's well north of 2%. Who knows where, they probably have the same phony numbers over there. I'm sure, we don't have a monopoly on lying to the public about how much the cost of living is going up. And we know, look, Japan imports all their energy, almost all their food right? The yen is collapsing, food prices are rising, energy prices are rising. This is a big problem. And I knew that something was going to happen here because they need to start propping up the yen. And one way to do that is with intervention. But how do they intervene? They need to sell dollars and buy yen. Well, the Japanese just don't have a bunch of dollars sitting around. They use their dollars to buy U.S. Treasuries. They own more U.S. Treasuries than any other country. They're our number one creditor. They have like 1.1 trillion of Treasuries. And I would say, hey, the Japanese are going to start selling Treasuries.
The important point here is not simply that Japan has a weak currency. It is that Japan sits at the intersection of two enormous markets, the yen and the U.S. Treasury market. Japan is one of the largest foreign holders of U.S. government debt. So any large-scale decision to convert those assets into dollars could potentially affect Treasury market liquidity and pricing. But there's an important distinction. The guest is describing a specific chain of events and interpreting Washington's motives. That interpretation should not automatically be treated as proof that the Federal Reserve is secretly monetizing Japanese debt. What we can establish is that U.S. and Japanese authorities have intervened to support the yen, and the Federal Reserve already has a standing facility that allows approved foreign official institutions to obtain dollar liquidity against Treasury collateral. So the real question becomes much more interesting. Was this simply a liquidity operation designed to stabilize markets? Or was Washington effectively trying to prevent a Treasury selling shock? That's where the story gets bigger.
Japan told the United States that we need to intervene in the currency markets. So we got to sell dollars to buy yen, which means we got to sell Treasuries to get those dollars. Now, the Fed, probably talking with the Treasury Department, was like, no, you can't do that, right? The bond market is tanking. The last thing we need is big sales by Japan, right, to push it over the edge that it's teetering on. So the U.S. government, right, made a deal with Japan, said, hey, you don't have to sell those Treasuries. Let's just do a repo with us. Let us buy those Treasuries from you, and then you can buy them back from us later on. Right? It's like a swap. You give us Treasuries and we'll give you dollars. So you don't have to actually sell your Treasuries to get dollars. We'll just take the Treasuries off your hands and we'll give you dollars. And that is what happened. And so the Bank of Japan, or Japan, whatever, got the dollars it needed, not by selling the Treasuries, but by giving the Treasuries to the U.S. And the Fed just cranked up the printing presses, or created the money that they needed. It was like $10 billion, right? That Japan had to then sell into the market to buy back yen. So this is a form of quantitative easing. It's just that the Fed is not going into the market and buying those 10 billion of Treasuries. The Fed is taking the 10 billion of Treasuries from Japan and then creating the money and giving it to Japan. And the crazy thing about it is Japan still earns the coupon on those Treasuries. So they don't have to sell the Treasuries. They get the dollars without selling them. They still get the coupon. So the United States is still paying Japan interest on the Treasuries that it doesn't even really have anymore, that it sold back to the Fed. Now, Japan has to pay interest on the money that it borrowed because the Treasuries are the collateral. So Japan has to pay interest on that loan, but the interest it's paying is lower than the coupon it's getting. So it's still a positive carry. So it works out great for Japan because they get the dollars they need and they're still making some cash flow on the Treasuries that are parked at the Fed. But what do we get out of this deal? The only thing we get out of it is the Japanese don't sell these bonds into the market. The Fed prevents that from happening. Why? Because the Fed is afraid, the U.S. government is afraid that if Japan is selling Treasuries, Treasury prices are going to fall. And so to prevent that, we create inflation. That is what the Fed did. They created more money, gave it to Japan to use to buy back yen to increase the supply of dollars in circulation. That is more inflation. And in fact, If you look at what happened to the Fed's balance sheet in the most recent week, it rose by over $10 billion. And that isn't even the $10 billion that came from the Bank of Japan. That is $10 billion in U.S. Treasuries that the Fed went into the market and purchased. So the Fed is not only doing quantitative easing without acknowledging it, but it's doing it even worse because it's doing it on the part of the Bank of Japan too. And if you think that's the end of the intervention, you're wrong. This is just the beginning.
There's a crucial distinction we need to make here. The Federal Reserve does have a mechanism that allows foreign official institutions to obtain dollars against U.S. Treasury securities. The New York Fed describes the FEMA repo facility as a backstop that allows approved foreign official account holders to conduct overnight repo transactions against Treasury securities held in custody at the New York Federal. In other words, the basic financial mechanism described in this interview is real. And this matters because Reuters reported that the United States and Japan recently carried out joint intervention to support the yen. Treasury Secretary Scott Bessent also said Washington would do whatever it takes to support Japan's currency stabilization efforts. But that does not automatically prove every part of the guest's explanation. For example, the claim that the Federal Reserve is deliberately creating inflation specifically to stop Japan from selling treasuries is an interpretation. It requires more evidence than the existence of a repo facility or currency intervention. The Federal Reserve's own July policy documents say it is maintaining ample reserves and can purchase Treasury bills when appropriate to maintain that level of reserves. Its balance sheet had also increased earlier in 2026 after the Fed ended balance sheet runoff. So the confirmed story is already significant. Washington has become directly involved in a major currency problem involving one of America's largest foreign creditors. And now comes the question that matters most. If intervention buys time, but does not fix Japan's underlying monetary problem, what happens when the intervention has to continue?
But what's going to be happening now and over the next several weeks, several months, is I think you're going to start to see the expectations for Fed rate hikes coming down. Not because the Fed shouldn't hike rates. It absolutely should hike rates. But they won't be able to because there's too many things going on to prevent them from doing what they should do. Now, they should do it anyway, right? And just let the chips fall where they may, but they're not going to do that. You know, especially with the midterm elections coming up, they're not hiking rates. And, you know, after the midterm elections are over, in theory, I guess, you know, they could, but I think the problems are going to be even greater then in the economy, in the labor market, and the Japanese problems haven't been solved. They still have to raise rates substantially. And when they do that, that is going to spill over. So we're damned if they do, and we're damned if they don't. The longer they try to avoid doing what they should, the more they're going to have to intervene, the more money the Fed is going to have to print, right? The more repurchase agreements are going to have to be done. So they're going to have to create all this inflation, and eventually the Bank of Japan is going to have to start jacking up rates anyway, and that still could create a financial crisis. Maybe the goal is to have the crisis happen after the midterm elections rather than before, but that might be about the only thing that they're able to do is delay this day of reckoning. But I seriously doubt that they're going to delay it all the way through the end of the Trump term. And who knows if Trump will even finish his term. I don't know what's going to happen. I mean, maybe he'll step down and Vance will finish it out. I don't really know because things are really going to get bad. And the president's popularity, as low as it is going to get lower. I mean, eventually it's going to start eating into his base. There's only so much disappointment, so many lies that they're ultimately going to be able to take. But in the meantime, oh, wow, I'm really starting. Somebody just went by. So the boat's really rocking around now. I picked up a little wake here. So in the meantime, this is the lull before the storm. Right? This week was a wake-up call. Right? I don't know how much longer you got, but you really need to get your economic and your financial house in order because the economic storm that I've been forecasting is just over the horizon. It is coming. So you got to batten down the hatches, because we are headed for a currency and a sovereign debt crisis. Yeah, you've got some positive things out there too. You got all the potential productivity boom from AI, but before we can get to that valley, we got to go over this mountain. We got all these problems that we are going to have to deal with. AI is not going to be a get out of jail free card, I don't think. I guess it's possible. Anything is possible. But I think you want to deal with the probable rather than just the possible. And the probable is we got a big problem coming. We got, bond crisis, currency crisis. We got to deal with it.
So where does all of this leave us? The most important point is that Japan's currency problem is no longer happening in isolation. Japan needs to stabilize the yen. The United States wants to avoid disorder in the Treasury market. And the Federal Reserve is already balancing weak economic data against persistent inflation. Those objectives can pull policymakers in completely different directions. The guest argues that Washington's intervention is ultimately buying time rather than solving the underlying problem. That is a prediction, not a certainty. But the reason the argument matters is because the underlying pressure is real. Japan still faces a difficult choice: raise rates aggressively, and it could put additional pressure on a heavily indebted economy while changing global capital flows. Keep rates low, and pressure on the yen could continue, potentially requiring further intervention. And that is where the consequences could extend beyond Japan. For the United States, a prolonged currency and bond market problem could affect Treasury yields, borrowing costs, the dollar, inflation, and financial conditions across the economy. But there is another side to this story. Intervention can work. Markets can stabilize. Policymakers can find ways to contain a crisis before it becomes systemic. So the question is not whether a financial collapse is guaranteed. It isn't. The real question is whether policymakers are solving the underlying imbalance or simply moving the pressure from one market to another. Because if Japan needs repeated support, and if global investors begin questioning how sustainable that support can be, the consequences could become much larger than a falling yen. And that is the warning buried inside this entire story. What begins as a currency problem in Japan can eventually become a question about global capital flows, U.S. Treasuries, and the strength of the dollar itself. The guest believes a much larger crisis is coming. We don't know whether that prediction will prove correct, but we do know the pressure is worth watching. So here's the question for you. If this pressure intensifies, what should Washington protect first? The dollar, the Treasury market, or global financial stability? Let me know what you think in the comments. And if you want more evidence-based analysis of the geopolitical and economic forces shaping America, subscribe to the channel.